Good morning, everyone. Welcome to our live stream. It's for those of you that have followed our channel. We used to do this every Tuesday night for 4 years. I think over 4 years, actually. And we stopped, and we were live about 2 weeks ago, actually 2 weeks ago today. And we were talking about the effects that DOGE was having on the housing market. Social media was ringing out everywhere with influencers talking about how the DC housing market was crashing, that inventory was exploding, and hundreds of thousands of dollars in price reductions were taking place on the houses that were being advertised for sale because government workers were losing their jobs and they were panicking, and we knew that wasn't true. And for those of you that have commented in the past saying that I don't know what I'm talking about, or I'm just trying to get extra views by hyping up a real estate crash and things like that. I talk what I know. I talk what I see with my own two eyes from boots on the ground. And I speak from the information that I have that is relatively verifiable. So, I came out 2 weeks ago and said, wait, guys, this isn't true. It's not happening. And but anyway, I thought that we would kick off our Tuesday morning live shows, that we would start doing this as a regular thing. But, last week, there really wasn't a whole lot of new news to talk about. So I'm thinking that maybe we'll do this every other week so that we can bring you the updates as we know them or have information to report, and really zoom in and hone in on what effects are happening to the real estate industry as a whole, the housing market as well as commercial, because they both tie together. And today we're going to talk about DOGE has made a lot of cuts to office leases all across the country, millions and millions of square feet. We're going to cover that today. We're also going to talk about how DOGE has cut a lot of the programs and funding to HUD, which is the U.S. Department of Housing and Urban Development, because I see a lot of people are coming out in protests that are saying that, they're cutting programs for affordable housing. I haven't personally seen that, but we'll take a look at what some of those cuts are. I think a lot of what we hear in mainstream media is propaganda. We got to cut through the sort of the BS, if you will, and get down to the brass tacks. And that's what we're going to do here today, and what I always try and do on our show. I'm also going to bring in, she's in a waiting room right now, Leslie Andren. She'll be joining us for about 20 or 30 minutes this morning. Leslie's the managing director for CF Capital, and she's very experienced in both the finance side of things, so she can talk to what she's seeing in foreclosures, and so I'm excited to hear from her. But she's also a multifamily expert, which is kind of really important to know what's going on in the multifamily space, because it's our rental market. And we know that millions of people have moved back home and they can't afford their rent. By the way, we have a poll as well talking about the recessions. We've got tariffs that went into effect today. We've got a recession that is zooming right along. So if you all could vote on this poll, it was just posted not that long ago. I apologize for the delay in that. But it says, your thoughts on a massive recession? Bring it on, baby. I'm not prepared. We won't have one. We'll actually have no landing at all. Just a soft landing. And then we put one in there sort of to be, a little sarcastic, but not really, because it could be true. But I live with my parents and I don't care. So maybe you guys we'll check that poll. Joe will remind me so that I don't forget, because I've done that before. We're also going to provide updates on the residential housing market, what we're seeing on a nationwide, more of a macro level. So, if you're in the market, or you just want to know about what's really happening in the housing market, right now, spring market's upon us. We're going to uncover some things. I'm also prepared. I have slides that I'm going to show you what is going on as a result, if we can attribute any of what's happening to the federal job cuts, to the federal spending cuts that are affecting even civilian workers. Because when one job is cut, we know that that doesn't just end there. It has a domino effect. And people are already starting to feel it. In fact, we're seeing right here in our own brokerage, we're seeing problems with some transactions. Riley, maybe you could bring me a pen. I forgot to bring a pen. I want to be able to take some notes for myself. But we're going to look at the markets that are surrounding DC. So these big job cuts, thousands of jobs that have been cut that are in the DC, Maryland, Virginia areas. A lot of these programs, people have lost their jobs right here where we are. We're starting to see it happen and affect our buyers and Maryland sellers. I have a story that I'll share with you that is happening right now. Anyway, we'll get started. If you're buying, I'm going to tell you also what I think you should be doing if you're in the market to buy or sell. I'm going to share some my personal insights as to whether I think you should buy, sell. If you are buying or selling, we're going to put that at the end because that may be a different group of listeners, that are in the market to buy, active in the market or would like to, or active in the market to sell. We're going to push that to the end. So if you're watching this and you don't care about any of the other things that I just mentioned and it's no longer live and it's published, you could skip all the way closer to the back. We'll probably go for somewhere maybe close to 2 hours. We'll see how it goes. And who knows, maybe we'll even take a live caller or two should we have time to do so. But without further ado, I'd like to bring in Leslie Andren.
Hi, Todd.
Leslie, how are you?
I'm good. How are you?
I'm doing all right. I'm hanging in there. I was speaking with one of our lender friends this morning. I actually worked with her a long time ago. Before we've known each other for a while prior to starting Sachs Realty in 2017. I worked at regional brokerages, and we go back to those days. And she was saying what a mess that is happening right now. She's a lender, great friend as well. But Leslie, explain to everybody who you are and why you're qualified to come on the show and talk about what we're talking about today.
Well, I'm a managing director of a firm that's headquartered in Louisville. We're apartment owners, and our firm has about a half dozen assets at various places in the Midwest. And I've been in the commercial real estate business for 40-ish years, long time. But I've done all sorts of different functions within the business. I've been on the financing side. I've been on the investment sales side of apartment properties. I've been in dispositions, acquisitions, asset management. So I've kind of worn a lot of different hats, which is a little bit unusual because more people tend to stay in one specific kind of function throughout their career. But I've always been too curious. And when things have really gotten slow or kind of a big downturn happens, that's when I've gone to work on distressed debt. So I happen to have a background in that as well as the apartment industry. And we're seeing some really interesting things in the business right now. I can't say they're all good. I mean, there's parts of the business that have been very stable, and then there's other parts of the business that are in some pretty dire straits, I guess I would say. Yeah, so that's what I've been up to.
Yeah, and you work for some big institutions too, and you were on the debt side of things. And during the GFC, you helped with a lot of, helping decipher, go through the distressed and dealing with the fraud and the abuse and the lending that should have never taken place. Are we still seeing lending that shouldn't be taking place today?
Well, not so much, really. I mean, I guess I would say when rates started going up, whatever it's been over a year, closer to 2 years, when rates started going up, it made it a lot harder to get deals to work in our business. It didn't matter whether it was apartments or anything else, because everybody was so used to having loans that they could borrow at a very attractive low interest rate that it acted as a big boom for the industry. It didn't matter what type of property, whether it was apartments, industrial, office. But what did happen when rates went up is a lot of assets that had loans that were maturing in this intervening time frame, they all of a sudden couldn't refinance at the level they had been at, which was a big problem. So especially on the office product side, and I'm thinking that will definitely continue in the DC area as the federal government decides to relinquish office space, and that it depends on who owns the building. Obviously, who's going to have the impact of that distress. But when you go from having a steady source of income, which is what the government was, so whether they were actually physically in the building or not, they were probably paying rent on it, and if that was to a third party owner, that third party owner is going to be experiencing some pain. And so that kind of pain has a ripple effect throughout the industry. And so we'd already been seeing a lot of foreclosures of really, like trophy grade office buildings in major downtown areas, which hadn't happened since the GFC. So anytime you have a situation where your loan is maturing and it matures into an environment where the rates are higher, that's going to cause a challenge for the borrower, because they're either going to have to pay down the loan to be able to get it to refinance, or they're going to have to work with the lender in some sort of a distress program to try to find a way through all that, which is sort of delaying the inevitable. But your choices are sort of limited at that point.
Just for people that are listening right now that may be saying, I could care less about office space or commercial real estate. It doesn't apply to me. I like working from home. Why should everybody pay attention to this, and what kind of a profound effect does it have on ordinary people when the commercial districts fail?
Well, that was the magic phrase you just said, when commercial districts fail, because when they fail, it's like a domino effect. So what happens is, if a landlord's building, goes into foreclosure and they lose it, if there probably had been people working in that building, my guess is there's always been some tenants that have decided to stay and brought back their workers from the pandemic back into the office. So they're now displaced. And then what happens is the ancillary other services in the area, the fast food restaurants, the boutiques, any kind of other real estate uses, they can also have issues, and they may be forced to close because they don't have the same foot traffic they used to have. So it really is important to all of us, and we don't realize it, even though you're working from home. My guess is there's a coffee place you like to go to that's not far from where you live, or there's some kind of a bakery or some other kind of fast food restaurant you might want to decide to go get food from once in a while because you're tired of eating at home. So there's this ripple effect that happens throughout the business where the two become, right, whether you're working from home and your home is okay and you've still got a job, that when people tend to work from home, that causes an issue in the first place anyway. And I get working from home. That's what I'm doing. I'm working from home. So I understand the desirability of it, but there are effects that happen to the rest of the marketplace. And that may be such that places you really liked are, not able to compete any longer because they're not doing the same amount of business. And I'm seeing that in my area, the suburban Chicago area already. There's 2 restaurants on the same major thoroughfare that's just like, call it 2 minutes from my house. 2 restaurants in the suburb of Glenview that have closed in the last 60 days. And that, I think, is partially because the inflation had moved up these prices so high that it made it harder for restaurants to continue offering at the menu prices they had been. So you see it happen, and you're not really thinking about that. That's connected to what's happening in commercial real estate, but it is. It's because there's some effect of how the traffic is coming to those places that are spending money where they had been, that they're not anymore, and so those businesses are failing. So that's what I would describe as why it's important to everybody. You don't necessarily have to follow it like I do, but when you start seeing things like that, there's a trend happening, and that we've seen the beginnings of that trend, and we're also seeing signs of a lot of additional, more than it had been, single family or just condo or townhouse foreclosures. So people are already starting to feel distress, and that is a lot troublesome and concerning, I guess I would say.
Yeah, and everybody, I'm sure, is familiar with what happens when you have a strip center or shopping center and vacancy starts moving in. There's a term in commercial real estate. It's called going dark.
Yep.
And what happens is because the lights are out. And what happens is when you're looking at from a commercial aspect, you're trying to do tenant placement that sort of cross sells with one another. So a lot of times when one business goes out of business, it's the same client. The reason they went out of business because of a pullback or, people not spending money, it's the same client for a lot of the businesses that are in that center.
Yep.
And then what happens is you start seeing people not feeling safe to go to places because there's vacancies, and maybe we start to see where now graffiti is being written on the walls, and now more loitering is happening, or the cutbacks because the management company cuts back, so there's more trash accumulating in the parking lot. So you start to see almost like some type of rot in the community because of these businesses that are closing up. And just so that it takes sometimes a decade or more to fill a commercial vacancy. This is not an easy thing to fill. Mm-hmm. So what we're seeing is that this does affect neighborhoods as well. It will affect property values ultimately. I want to pull up, Leslie, an article that Bloomberg published here, and then I want to dive into a little bit of talk about the cuts, the DOGE cuts, because this is accelerating an already damaged and fractured commercial real estate business, guys, or market. And by the way, a lot of the stock market, there are a lot of stocks, a lot of these publicly traded REITs where people are investing in, they're depending on income. So it affects a lot of people whose investments are invested in owning a fractional piece of real estate through a REIT or something like that, some kind of a fund. But this Bloomberg article, here we are, February 28th, DOGE risks a new $5 billion headache for struggling U.S. landlords. And basically it's saying that they're rapidly cutting office leases. They're talking about a 2-mile stretch in Washington, D.C. I just want to look at it because this information's not even accurate. It's much more than what's shown in this article. That's why I want to pull up those here. But I want you to see some of the visuals that are in this article here, because this is showing D.C. and the areas that major cuts are happening. And D.C. has already started to experience, even prior to the election, prior to the DOGE cuts, D.C. was a declining market, a declining housing market. There has been reports that the area's declined a lot. And, it really got expensive. And then you started, hearing where, crime had picked up in a lot of areas, and things were happening, and people didn't feel safe going to the restaurants and things like that. And this is all in the news. Trust me, you don't have to take my word. You can look back at this stuff. But when we look here at the the impact of a local market, there's a lot that was affected. But I want to go back, and what we can see here. The U.S. General Services Administration, or GSA, responsible for the leasing and management of government buildings, pays roughly $5 billion a year renting 144 million square feet of offices nationwide. That is equivalent to nearly a third of Manhattan's entire office stock. That's a lot of space. It says here that the cutbacks could affect all 50 states. Again, it says 3 million square feet. It's more like 9 million square feet. And it says another 74 million are set to expire during Trump's term. This is just a little, illustration here to show you the where most of these leases are. And, hey, here we are, guys. My market, Maryland, and DC and Virginia are the biggest bubbles here that you could see. But let's take a look, Leslie, at let's look at this real estate. This is on DOGE.gov. I don't know if any of you have gone on this site before. A lot of controversy as to the cuts. I think a lot of people are saying that, we all want to know where the money's being spent. I think Elon Musk has made it clear that if he makes mistakes, they're going to reverse it. The controversy is, depending on how you're affected by it, you may be more passionate one way or another. But let's just take a look here. So I'm just going to scroll through here and just kind of show you, Joe. I don't know, is there a way that we can show the right side of the square footage of the? If this helps. Oh, I got it. Never mind. All right. Leslie, I don't know if that's your microphone or what's happening, but all right, here we go. So this is the amount of square footage in the right column, but these are, as you see, almost 10 million now square feet and 660 million in lease savings. Now, Trump had said when, I don't know, at least once I've heard him say, you're coming back to work. Be prepared. You're coming back to work. We've had a lot of people that have called us saying, hey, I'm living in Florida. I'm living here. I'm living there. I need to come back to Maryland. My job's calling me back into the office. But yet at the same time, we're seeing almost 10 million square feet of office space canceled right now, 660 million in lease savings. The question is that comes to mind, you're not coming back. I mean, are you coming back or are you losing your job? Are they going to tell you where to go back to work? Because this is some significant space here.
Yes. And that's the thing people don't necessarily realize. The federal government leases office space probably in every state in the country. And so it has an effect outside of just DC. And even though the federal government, the GSA, is not usually the landlord in Class A office space, they tend to like less expensive, not as glamorous buildings, let's say. Those, as you said, those landlords are depending on that income. And it is a bit of a scary proposition now. I get the whole idea of there's probably a lot of office space the federal government's paying for that they haven't had people in that office building in who knows how long. So I'm sure that they're looking at that as well as the number of workers that they have who aren't really doing something valuable, that earns their living. So, there's this yin yang push pull thing happening with that, because as the government identifies where there are areas where they're spending money that they may think, well, let's not spend money there because it's not really benefiting anybody other than the people that are pulling down a paycheck, meaning that there's no valuable thing that they're producing on a day-to-day basis that would warrant the government having that office space to house them. So it's bigger than just giving up office space and or someone losing their job. It's both in a lot of cases. So when you have that happen, because what happens then is you've got a landlord who's got to fill his space up. You've got a person who's lost a job who has to find a new job. And whatever that building was doing before, it's probably not going to be doing again. And that's going to affect all these other uses. When I say uses, I mean all these other real estate locations, whether they're office, retail, industrial, whatever, that has a effect. I call it the ripple effect because it does translate itself across a number of dimensions in a given area. So I think you're right to be bringing this to people's attention. Or I think the other thing that people need to bear in mind is that I view the housing market in a bit of instability as well. Because rates are higher, obviously, than they were a couple of years ago. People would prefer to be able to buy at the rates that were happening prior to this increase, but it was a necessary increase, if you will, because inflation was on this just upward trajectory. And I'm sure everybody understands how inflation has affected them. There are all sorts of things that you're now paying more for that you weren't before. And that in and of itself has led to businesses closing. So there's all these different dynamics from a more of a macro perspective, if you will, if you want to talk economics. There's all these different effects that are coming to you in your home, if you will. Whether you work at home or you don't, there's things that are happening in the larger marketplace that are affecting people every day. And I think part of what DOGE is probably trying to accomplish is to right size, they view it this way, is to right size the government. Because the government has gotten to such a large, the size of the government has gotten so large that our national debt is increasing quite dramatically because of it. And I think that's really the root of all the issues, is what to do about our national debt. And that has, I think, a big impact that people may not even be thinking about, because what's happened with our national debt is that it's getting to be so large, in the $30 trillion range, that we can't sell any new paper. There aren't very many buyers for our new paper, which is a big concern. And not just that, is are we able to continually service that debt on an ongoing basis? Meaning, are we be able to pay the interest that's due to whoever owns the existing paper? And there are so many large things out there right now that are scary. Honestly, there's times when I just try not to think about it, because if you add up all these factors, we are in an unstable economic time. That's how I would describe it.
Leslie, and we haven't seen anything yet.
Right.
I mean, so what a lot of people don't realize, yes, everything you're saying is true. We probably have let things get out of control. And not that it was my fault or your fault or anybody's specific fault or even the federal employees' fault. Right. A lot of them, I'm sure a lot of them do a great job and work very hard and are faced with, some challenges that as a result of being let go or the threat of being let go. But what people don't realize is the magnitude of of what happened. So first of all, I would venture to say, and you would know this better than me, but as a lender, if I have the federal government as a tenant, it's probably full steam ahead. You get whatever you ask for. You're getting the money, because that ironclad lease from the federal government is money in the bank. So the question is, have these landlords or these funds or these REITs been gouging the government because they have been leasing to a, sort of like a endless money pool? What kind of, what do you think kind of oversight and, is taking place on the negotiations of these leases when they've been leasing them for crying out loud, a lot of them have been sitting empty and they're paying the leases, keeping the lights on, having the offices cleaned, the bugs picked up, the birds from the outside flying into the windows. They're cleaning up the place and it's sitting there vacant. So we've already know that these leases probably go back 5 years or more, but probably a lot of these offices that have been cut, many of them have probably been occupied for decades. What is the process of, do you think these landlords, do you think these commercial landlords are kind of, getting what they should have expected if they would have been leasing to any kind of private organization, or where do you think that stands?
That's a good question. I would say, I can't speak for every place where the federal government has leased and what that building is like, but I have had buildings that I've been responsible for with debt on them from the lending institution I worked for in the past, that the GSA was a tenant. They're considered what's called a credit tenant, meaning that cash flow is almost as secure as a AAA bond. You see what I'm saying? Meaning that it's viewed as a very secure source of cash flow. So in the market, it's graded as a Class A tenant, whether the space is really built out like that and the workers that work there are in that kind of office space. They often may not be. And that's usually more what I've seen when you have the GSA. It's a lot of times it's back office space, which means it doesn't have all the bells and whistles of a beautiful brand new Class A office building. So from that standpoint, I would tell you most landlords are setting their rents depending on the conditions in the larger market. So if the market is really robust and there's no vacancy of office space, landlords can charge more. It's just like anything else. So I would tend to argue that they're not gouging the government, because the government has plenty of people that understand what is happening in the market and what should we be paying. And they generally, because they are a credit tenant, they don't pay as much. They tend to pay the lowest rent because they've got the most negotiating power. But even saying that, I mean, you have to think about the broader marketplace, which is that if there's more vacancy in a market that's created because landlords have seen tenants that have gone out of business or who have refused to sign a new lease because they want to go elsewhere, or whatever the reason is that they're not retaining that tenant. If you see that across the board, then obviously there's more negotiating power for the tenant, just like in the home sales market. When there's fewer houses to be had, that gives the sellers a priority in the marketplace. So it's very much the same kind of dynamic. And so I would say that what's happening right now is what's happening at the personnel level. It's not as much what's happening at the real estate level, meaning that office building, although that will be happening soon, I believe. But they're trying to right size the amount of people that work for the government. And once they know that, then they'll be able to decide how many office spaces are they going to relinquish, because they don't need people in that location. So I would say this is a process that isn't over yet. I would say that it's coming at a time where office space is particularly vulnerable because there have been so many foreclosures, and I don't see that that's over yet. About the only thing that's going to cause this market to become more of a go-go market again, where everybody's feeling the benefits, would be if interest rates decrease, and I don't think that's going to happen anytime soon.
Well,
so that would be my long answer.
Interest rates. So just so everybody knows, interest rates more than doubled for these commercial. I mean, you were getting 3.75% for
Right.
a 10-year loans amortized over 25 years, 25 years. Landlords were able to make money. So they've dealt with vacancies. It hurt their bottom line. Interest rates are now at 9 handles for commercial real estate, on average, more expensive for higher risk, less expensive, I would guess, if you had maybe a AAA bond rated tenant, and it was, and the bank really wanted the loan. But Leslie, 748 leases have been terminated according to the DOGE site already. 9.5 million. We got to pull back up here. 600.
I did not know that.
600. It's already 9.5 million leases canceled. This isn't something that they're figuring the jobs out. They're cutting leases. They're done. Contracts canceled.
Yeah.
It's over. 9.5 million square feet right there. 748 lease terminations totaling 9,587,384 square feet and 660 million in lease savings. Boom. Done.
That's a lot.
Here you go. Miami. We can just look through here. Some of these, right? Here, look at this. 119 in Atlanta, 119,000 square feet. Look at this. 845,000 square feet.
That's a lot.
Right? So not all of these are, some about 23,000 square feet, 46,000. All right? 23,000. Mobile, Alabama. Atlanta, Georgia, another 17,000 office space. Here you go. Fairfield, Ohio, 124,000 square feet.
That's a lot. And I hadn't really realized how much office space they'd already canceled, because generally it is a process, I guess I would say, when you're trying to identify what your office space needs are. It doesn't matter whether you were talking about the government or private companies. You're trying to determine what your office space needs are. You're really looking at the viability of your business and how many employees you have, and whether you think that number is going to increase or decrease. And obviously, this is a case where that's a lot of space, and the government's already decided we either don't have anybody there or we don't need anybody there, so we don't want to pay for that any longer, and we're going to cut those costs. And that's the backdrop to all of this, is that the government is trying to eliminate as much, they're trying to identify and eliminate as much source of the cash flow they have to put out on an ongoing basis so that they can manage the amount of the national debt. That's what's behind all this. Because if we're borrowing to be able to afford all this, and we actually don't need the people in that location, that obviously there's a choice to be had there, because they want to, make sure that they're using the taxpayers' dollars wisely. That's the backdrop, because just increasing the debt the way we had been, that was an inflationary factor. So I think the idea behind all this is so that the government, if it can right size itself, meaning to a number of employees that it actually needs, and same with the office space, then the hope is that that money that we've been borrowing to afford all that will decrease. So imagine yourself, like if you were going to go out and buy an additional piece of real estate and you wanted to use it as a source of cash flow because you're going to rent it as an Airbnb, but you all of a sudden stop getting any kind of traffic, nobody's renting, are you going to continue to support the loan on that? If it has a loan on that, you're going to try to sell that because you're not seeing the business coming from it as you were. So it's really, people can translate what's happening here to their own personal level. And I think that's the whole challenge with what the national government does. I feel like there is a mentality that it's sort of the ostrich, your head in the sand, because you're not thinking about what are the larger effects from what's happening here. And that is somehow this belief that the federal government can endlessly spend money as though the taxpayer has, their pockets are continuously overflowing. Well, that's not what happens. That's not the reality. There's a limit on how much people can afford, and there's a limit on how much the national government can afford. And so I think that's really what's behind all this. And I think that in the DC area, there is going to be continuing effects of this until it stabilizes at a level where they think it's, that we're at the right level of office space and people working in them.
Imagine, so almost 10 million square feet of office space has been added to the already glut and destroyed commercial real estate market. Imagine filling that, repurposing this space, because most of these buildings have functional obsolescence. Mm-hmm. They renovating office buildings without a tenant in mind. What does that do for the other tenant structure in the place as the landlord's costs go up and profits go down? In all of this, we now know that a lot of our building materials come from Canada, and a lot of our building materials come from China, and a lot of our building materials come from Mexico. We now know today we have trade tariffs in Canada and Mexico, 25%. These building owners now, on top of going, oh crap, now we need to fill this space. But we're also looking at the fact that to renovate this space, because tenants want improvements. You get a new tenant in there, they want to improve. They want the landlord to give them some kind of concession to move, to sign a lease in the first place.
Right.
So what do you think what do you expect to see? I know, Leslie, you got to get off of here, but quickly, can you give us some of your wisdom on, your predictions moving forward?
I would say that until this sorts itself out, there is an instability in the larger marketplace across the U.S., meaning that what happens in D.C. does affect the rest of the country. As we've seen, there are leases all over the U.S. where the government has space already giving a lot of that up, probably may continue to give up more. And when that happens, as you said, the landlord's faced with a dilemma because they have eliminated that lease when that landlord counted on that continued cash flow. And without that cash flow, meaning that their property isn't as secure as it had been, it's going to be a lot harder for them to, if they want to finance those renovations, it's going to be a lot harder for them to do that. It's going to be a lot harder for them to find a new tenant who can afford the space, whether it's renovated or not. Those kinds of open, empty spaces can take, as you said, years to fill. So if you're seeing this across a number of different locations, that I think we haven't quite seen how dramatic that effect can be. And so I think the ultimate stability that hopefully comes from this will be an improvement, because then, there's less taxes that are needing to be generated from the American public. There's less debt that the government has to take on. It can now start to focus on what it really needs to do as the federal government. What are these functions that we were paying for before that we no longer need? Well, that's really, private companies do that all the time. They look at the way their operations are going, and they're looking at that, and they're saying our cash flow is down from this source. So should we continue with that line of business? That's basically what's happening, is the government is saying, should we continue with that line of business? And that what happens with that is now what we're seeing, which is that people are losing their jobs. There's more office space that can't be filled. There's an effect on the lenders who have now a loan that may not be servicing its debt. So I don't know that this is going to lead to a deep recession, but I can't say that it won't either. I'm not an economist, so I can't really tell you for sure, but there's a lot of signs. And we've talked about this before, Todd, where there's a lot of signs that you could point to that are more than they had been in prior periods that would tell you, oh, this is not a good thing that's happening. We're seeing housing starts decline as of this year. We're seeing multifamily starts, meaning new construction, decline. There's a lot of different signals that are happening that would tell you that people are expecting the ride to get rough for a while. Whether it really gets terribly rough and we see a real recession, hard for me to say, but there's enough signs that people who do know are saying, gotta worry about this. This is time to hunker down. So I think what we're seeing as a result of that is a lot of people are stepping back and not necessarily buying a new home, or the people that were selling their homes are deciding not to sell and they're delisting their homes. So I'm guessing we've probably seen some of that, Todd. I know we're seeing that here in Chicago. The people that are selling are the people that have to sell. And what that does is it sort of puts a damper on people moving up, meaning they want to sell their existing house because they need a bigger house or whatever their situation is. But I think that trend could become more evident because we're already seeing signs that there's a slowdown in new construction, which tells me that there's less viability happening in the marketplace, that people who depend on building for their source of income, if they're starting to pull back, that's a huge because they need to continue to build in order to make money. Doesn't mean they won't make any money. It just means they're not going to make as much. So they're having to pull back because they're looking at the signs and they're saying we're not seeing as much traffic. There's a woman that I follow. There's two women that I follow on YouTube who I think are really talented in understanding all this. One is Danielle DiMartino and the other one's Melody Wright. And they have a good handle on what's happening in the market. And when they say they're seeing issues, I tend to listen a lot because that what happens on the for sale housing side of the business affects my business. There's no way you can get around that. And that is that's a fact. And it's also a concerning situation when you start to see the signs of softness occurring on the for sale housing side, or the to be built housing side, if you will. So I would say I'm not optimistic, but I'm not totally pessimistic either. I know that's kind of a hedge answer, but we've made it further than I thought we would. The distress that banks have had, while it's been more than it had been in the past, hasn't been that much where they've actually across the board staffed up. There have been banks here and there that have staffed up on the distress side of their operations, meaning that they've got more loans that are going into distress. That there are more loans that have gone into distress, but they're not so much that the banks have had to say, "Oh, we really have to expand this department," because that was one of the things. As you know, I was recently looking for a new position, and I had been talking to a lot of lenders because with a lot of major banks in Chicago, and most of them might have added one person or two, but they weren't adding like 10, 20 people because they didn't see that they were going to have that much in the way of distress debt. So that's an interesting factor, I guess.
Yeah, but Leslie, I got to interrupt there. I mean,
Yeah.
the problem is that the federal government basically took Fannie and Freddie into receivership. They're the ones that are underwriting all of the
Right.
of the loans, the most of the residential conventional loans, and FHA and VA are financing the other one. So it's government backing all of these mortgages. And let me tell you something. It doesn't look good. The only reason why people aren't staffing up on their, their distressed personnel to handle it is because they are not silently, you can find it, but they're packaging these non-performing and reperforming mortgages and selling them by the tens of thousands. Yeah. And this has been going on for several years now, and we don't hear about that. So what's happening is we're not seeing that inventory come in because it's going somewhere else. And a lot of these people that are buying it and bidding on it are hoping that if they don't pay, they'll be able to turn them into rentals.
That's true. And that is an important factor when you look at it from the standpoint of the federal government that's giving up office space, but it also is the lender. Then, I guess the size of the dilemma is just much larger than anybody had really anticipated. It wasn't until these cuts started happening where you started making those interconnections, if you understand them. I mean, we've been dependent on Fannie and Freddie in the apartment financing business for a long time. So that isn't a surprise. But what Fannie and Freddie do, you're exactly right, is they bundle up a whole lot of loans that have gone bad, meaning the person who took the loan out isn't paying any longer. So they package those up and they sell it to Wall Street, and Wall Street buys that paper for cents on the dollar. So the original loan amount was up here. Now someone's buying those paper pools at a much lower rate. So they've, in essence, bought the real estate at a much lower rate, because if the debt isn't any good, that means they can foreclose on the original owner of the property and then take over the ownership themselves and then go lease that to someone on the open market as a rental property. And we're talking about a lot of home loans, and that could happen. And we're starting to see a lot more of that in certain parts of the country where I don't think we'd seen it as much before. You're in DC, so you definitely see a lot of the effects. But I haven't been to a downtown area that is stronger than it used to be since the pandemic. Doesn't mean there aren't some, because I certainly haven't been to every major metropolitan area in the country. But think about it. I mean, you can see it. There's a lot of ancillary services, restaurants, shops, whatever, that never came back, and those spaces have yet to be filled. So we reached some sort of, like, maybe call it temporary stability, but there's, I guess when you look at all the effects, which I certainly haven't been able to do, but I have an understanding of what enough of them are, there is cause to be concerned. And ultimately, I think there has to be a new confidence replaced in the marketplace where people feel like their jobs are secure and they're going to do better, and they're going to want to take on more debt, if you will, to buy more real estate. That needs to happen, and that we're not anywhere near that right now. I don't think. I think there are more people experiencing foreclosure of their homes now than there has been in a long time, and that's a really bad smoke signal, if you will.
Yeah, and that's coming off of a several year high of a lot of stimulus money that was handed to homeowners that were distressed and helped them to pay their bills. Many of these were actually failing well before 2019. And I guess in some aspects, they were saved by a lot of the money that was handed out. And the other issue that we have here is that people don't have any money. I mean, people are broke. They're living on credit cards. Their
Right.
car payments are off the. I mean, a lot of people
There's
aren't
a
even
lot
paying
of
their.
defaults.
I mean, $1,000 car payments. They don't have the money. I mean, how many hours do you have to work at your job on an average wage to pay $1,000, $700 or $800 car payment? And that's not even counting your auto insurance, right? So how many people went out and bought over asking price? These dealerships are full. You can buy luxury cars for pennies on the dollar. It's all crumbling down fast, and we're going to see it. And and it's like, what comes up comes down. The bubble is gotten so big, and it dwarfs 2008. It makes it look like a walk in the park. Okay, because a lot of people that you talk to about 2008 today, they don't even know because they were in college and they were basically unaffected. These
Right.
are the new homeowners that bought $100,000 over appraised value. They borrowed money from mom and dad. We're seeing the effects of the stock market in one day when Trump said that the tariffs were going through. Mom and dad's invested. At least mom and dad that can afford to give you $100,000 to overpay on a house, they're directly affected when the stock market busts. So nowadays, in this round, which we're getting ready to cover, I know you won't be here for it, but we're going to cover the housing market, what is going on. And look, let me tell you, these buyers, they ain't very excited. So you do have pockets where people are like, woo, yeah, I want to buy a house. Most of them are saying, I can't afford one.
They
So,
can't afford homes.
yeah.
That's a bad. And here's the thing. I guess when I said I was sort of hedging on where this is going, we've been wondering now for the past 5 years if this is really going where we think it's going to go. That's the thing. So we've held on a lot longer than I expected. But I will say that when recessions occur, the economy unwinds very slowly, and then all of a sudden it happens very fast. So that's
when the money turns off.
that's
When the money
exactly
turns
right.
off, it happens fast.
That's exactly right. And
Fast.
so we're all sitting here going, well, we've been reading all these smoking signals for 5 years. We would have thought that would have happened already, and it hasn't. And now you're really seeing the distress across a number of dimensions where it had been before. So those factors are all really important. And it is concerning. I mean, I think that if you've got a job, damn well do your best to hold on to it, because if you lose your job, it is a marketplace where it's going to be, I think, harder to find new positions. And God forbid that's a bad place to be, because you're being challenged. Whatever your savings are, hopefully you're going to be working through what to do with all your credit card debt and your home loan if it's in distress. And that's a challenging thing because a lot of people haven't had to deal with that. And I feel badly for them when they do, because it's a set of skills that they don't get unless something bad has happened. But at the same, meaning that it is a set of skills as to what to do with all that debt if you can't pay the amounts on a monthly basis. And you basically have to talk to people. Tend to bury their head in the sand and not pay attention to what's happening with that, and want to just like push it off to the side. I think that's the worst thing you can do, because none of the people that you've borrowed money from, whether it's a credit card or a home lender, they don't want to not get paid. They understand when people go into distress, and they all have departments that focus on that. And so
they all don't want to not get paid, but they have no problem charging you 25% interest so that you're making your minimum payments. You're getting kicked in the teeth and the face and the gut and everything else. When you're down, and they're reaping because of it, right? And you know what? And a lot of it is, hey, look, if you lay down with the devil, you know what I mean? You can't expect good things to happen. Debt is not a good thing. And I think and that's what we're realizing, that hey, look, we all been living on debt. The government's been living on everybody's been living on debt.
That's right.
So your leaders at the top are telling you, well, it's not important to balance the budget. No, we don't worry about it. We'll just live this
Print
way.
more paper.
The problem is now, guess what? We are where we are. And it comes to a certain point where we already saw what happens. You give everybody, you bail them out. It doesn't work. No lessons are learned. They are in worse financial shape today than they were before any kind of a handout or a bailout. We've bailed out businesses in corporate America. We should have
Right.
never done it. We should have let them fail. We shouldn't be involved. The government shouldn't be manipulating any sectors, whether
I
it's
agree with
crony
you.
capitalist or mom and pop shops. The bottom line is, you run your business where there are consequences of your actions, your decisions, whether they're good or bad, and we got to stop this bailout crap that's happening. But Leslie, I know you got to get out of there.
Unfortunately, I do have to go.
I know.
Talk to you for hours. I
We-
really enjoy talking to you, Todd.
We appreciate it, man. I love having you on the show. We got to do it more often, and thank you so much. Leslie's LinkedIn is in the show notes here if you want to follow Leslie on LinkedIn, and we hope to have you back soon.
Thanks a lot.
Talk to you soon. All right, so we're going to continue this conversation, guys. A lot of things that I would have loved to, talk with Leslie. We'll have to continue that conversation. But, we talk about, well, what do we think is going to happen in the housing market? Look, none of the situation that's going on right now is great. Yes, we might have greatness at the end of the rainbow, if you will. The pot of gold may be there, but you can't take, well, you can because it's happening, a system that's been going on and how much it's supplied and how much it's provided into the private sector, into you, ladies and gentlemen. You don't even realize it yet. But when these things are yanked back, don't think that you're going to escape the feeling of pressure financially when, we're paying more for products, that we have inflation. Deflation doesn't work in the country, in the United States. We have no reverse gear. It doesn't work when home prices crash. We know what happens when when that takes place. We witnessed it on this side of World War II. That just not that long ago, in 2008 through about 2011, 2012. Actually started before that, 2005. With new home construction. We know that when prices come down on assets, it crushes financial institutions. That's where your money is. That's where your pensions are. These are the things that are affecting us right now. So there is no easy way. We can't just inflate this away, in my opinion. Leslie talked about the economists. Most of the economists don't, in my opinion, they should find other jobs. A lot of these economists, I don't know what the hell they're taught in these universities, but me and a couple buddies sitting around smoking cigars have better insight into what's actually happening and what could come down as a result of this than these economists that are working for special interests, working for different agendas, pushing narratives that never made sense to me. It doesn't make sense. When you take the foundation of America, which is housing, a roof over your head, and you make that unaffordable for the majority of the population, that's bad. Okay? Especially when you allow these asset prices to double. That's bad. Especially when job growth, your salaries can't pay for it and keep up with it. And then you're whacked with everything else. But, what I want to do here is I want to dive into some, because we could, I don't know, where are my old Tuesday night live listeners that say that was probably rant number 6 or something. Let's cover a couple things. I want to go, I know we're going to run close on time. I don't want to keep you that long, but real quick, I want to go over the DOGE site one more time. I put together and I think it's in here somewhere. Is this it, Joe, where we've got agency? All right. So I want to talk about the housing and urban development, HUD. I want to talk about the cuts that are happening here, and I want to look at some of this stuff because a lot of people I'm seeing, protests saying that the DOGE is cut. We're going to do away with affordable housing. What the hell have we done for affordable housing? I'm surprised when the words are coming out of people's mouths. DOGE is cutting programs for affordable housing. Where is there affordable housing? Where have we seen affordable housing in the last 4 years or 5 years? Now, don't get mad and say, well, now he's a Trump supporter or, not a Biden supporter or whatever. I don't care about that. How can you look yourself in the mirror and say we've had affordable housing? Now we want to protest about it. We don't have they're cutting affordable housing. I don't think we've seen affordable housing. I'm in the industry. I work in it every single day. You show me affordable housing. It doesn't exist. Now, if you're talking about subsidized housing, that's a different story. But don't go down the path of affordable housing because it doesn't exist. Now, let's look at some of these things. Now, I highlighted for you, and I scraped this information from DOGE, my own little creation here. Don't make fun of it. I'm not a, graphic designer or anything like that at midnight last night when I'm trying to get you the most up-to-date information, which I'm going to show you on DC, Virginia, Maryland, surrounding the effects that we're seeing. I'm about to show you all that. Right here, I wanted to just look at housing and urban development because of all the chatter about the crashing affordable housing. These highlights are the most cuts. A lot of these have to do with green energy. Now, look, I lived in an affordable house when I grew up. Yeah, the air blew through the glass. It was old. My house was 100 years old when I was living in it many years ago. It was passed down from the family, from my great-grandfather to my grandfather. A lot of this is green energy. These contractors, you can go on DOGE. I've published all the links. You can look and see who is the recipient of these contracts. And what we're seeing on the right-hand column here is value of the contracts, not the savings. You have to click on each one. It will take you some time. But if you're really interested in it, go ahead and see. A lot of the savings are zero. They've cut these contracts out. But what I'm interpreting from that is it ain't happening anymore. A lot of these government contracts, there's a little, a little acronym that basically says that they don't know how much it's going to cost. So when they're getting bids on like this endless, we don't know what it's going to cost. It could cost more money. We might need more money. A lot of it will just keep on going. And they may go beyond the contract dates. I don't work for the government. Many of you that do have lit me up in the comments saying, I don't know. I don't understand. You're probably right. I don't understand. I don't know. I don't understand it. Right? So don't be mad at me because I don't understand it. Instead of saying that I'm an idiot and I don't understand it and I'm saying something that I shouldn't be saying, tell me why. Let me know why. What am I saying that's wrong? I don't know. I've got, these receipts in front of me. It's showing me where the money's being spent. I have to determine for myself, do I think it's a good idea or not a good idea? But I tell you what, it's a lot of money. So you add these up. Data program support services, $4,290,578. Digital asset management solutions, $5 million. These are government contracts that were issued to companies, and the money, it's saying stop, no more. One of these, I'll get through, and I can keep going on. But look at this: office furniture for the Atlanta office, $4,832,300. It seems like a hell of a lot of money for office furniture. I don't know how big's the building. I mean, maybe they spend that much decorating the White House, but I don't. If office furniture for Atlanta office for housing and urban development, $4,832,000. Look at this one. Ginnie Mae optimization and transformation of GOAT. Now, I thought maybe it was something that was in the backyard, butting heads with each other, eating, metal cans, GOAT. I didn't know what GOAT was. Try and look it up. You got to go through a couple different things to see what it is. It's Ginnie Mae optimization and transformation, $41,714,000 that the government is spending. Ginnie Mae, or was. Project management and business analysis, $4 million. I mean, look at this. Centralized data management, next gen. $9,369,000. Now, I'm sure maybe it has a lot of, high-tech security stuff in there, but nobody's been hacked before, even with the high-tech security stuff, right? I mean, somebody opens up an email. It's as simple as that. They spend billions of dollars on cybersecurity, and an employee clicks on something they shouldn't, and boom, the bad guy's in. And we get these letters that say, hey, your data's been hacked. It's been stolen. Let's talk about the housing market because I promised you that, and that's what I do for a living. So let's go ahead and cover this. So 2 weeks ago in my live stream, all right, I don't know, is there a bunch of I don't know what just happened with that thing, man. It was like I was hallucinating or something. Oh, you were sharing my screen. All right. Okay, well, let's share it. Let's see Washington, D.C. and surrounding counties and cities. I showed this 2 weeks ago. And, like I said, social media guys all over the place are going, oh, my gosh, the world's falling. Government workers just lost their job 2 weeks ago, and they've put their house on the market, and they're selling it at a fire sale. Not happening. That doesn't mean that the real estate market is good, but that ain't happening. There's still lawsuits are being filed. Unemployment is, county councils are having job fairs. Governor Moore here in Maryland said he's going to hire all these people that lost their jobs. He's going to make them all school teachers. Maybe he will. What we're talking about here, Washington, D.C. and surrounding counties and cities, these are the areas that we see as somebody that works in the area, actually sells real estate, boots on the ground, manages agents to sell real estate. We're dealing with a lot of government employees. In fact, we've got problems with buyers that are wanting to buy. They can't buy right now because they don't know what's going on. I understand it. We got sellers. They don't know what's going on. They want to move on to a bigger house, which I don't think is going to happen. I think we're going to wipe out the big houses. We're going to have a big problem with big houses. And because what we've done is over the years of not allowing wages to catch up with asset prices before we let the asset prices skyrocket like the price of a home, the builders are just building McMansions that people can't afford, especially now with the cost of repairs, the utilities, and all that stuff. So it's a problem. We got a problem. So do you want a big house or do you want one that you can afford and actually afford to heat and cool and not get foreclosed on and afford the repairs when it needs a roof? Do you want to buy a $20,000 roof or a $200,000 roof? These are the questions that many people are going to have to face, but let's look at this here. So we're talking about these areas, and what do I got to do? I got to click through each one of these things? Isn't there a way just to go through them? I don't know. Oh, you pulling it up for me. All right, good. Washington, D.C. Thanks, Joe. So what I've done here, I just want to briefly explain. I'm not going to explain it on every slide, but I want you to know what is that me? Guys, I'm a real estate broker, man. I'm not a tech guy. Anyway, Washington, D.C. I want to just explain these slides here, and I'll only do it one time, and you guys can get it from that point on because you would be bored to death if I didn't. But I only captured homes that are over $200,000. So if you know anything about the Maryland, D.C., and Virginia area, if it's a home, if it's less than $200,000, it's got a lot of problems, right? In most cases. Or it has an HOA that's $5,000 a month and it prevents them. They got to sell the condo unit at $120,000 because nobody can afford the condo fee, which, by the way, we do have places that are like that. But we're going to cover these areas. So this is homes for sale over to north of 200,000. The left column is our live stream information that we provided on February 28th. I thought that was the best way to do it so that you can see for yourself what's happening. And then, of course, today I waited till after midnight. Yes, worked well into the morning so that I could bring you this current information. You guys wouldn't check and be like, he's wrong. It's 2040, not 2042. Coming soon, homes that are poised to enter the market. They've entered the MLS. Nowadays, you can do that for an unlimited amount of time. Prior to the new MLS rules that changed as a result of lawsuits, you were only allowed to have an existing home incoming soon for 21 days and new homes for 2 years. But now they said, well, you could put it in for as long as you want, as long as you have an idea of the list or live date. So coming soon has gone up modestly, just not that much. Active listings, not that much, going up from 1943 to 2042. Again, we're talking Washington, D.C. The most disturbing part here is that we're in the spring market and the price reductions have increased. So we're looking at, don't worry about the numbers, look at the percentages because that tells the biggest story. So when we're looking at of the active inventory for sale over 200,000 in D.C., Washington, D.C., 37.2%. It's a jump from 2 weeks ago of the inventory that has had price reductions. Guys, we're in the spring. This is not the time we reduce prices. It's March. This is telling a big story. Active under contract has dropped. Active under contract means that the agent, for whatever reason, and the client has decided to put it under active under contract, meaning that there are contingencies that have not been fulfilled. It could be anything from a home inspection, well and septic inspections, financing contingencies, selling another house before they can buy theirs. But they put it in an active under contract status, which means that they will continue to show the home. It's still active. It's under contract, but come and have a look. We're accepting backup contracts. Maybe we have a reason to believe that it won't go through. Some agents just do it, I think, because they don't know the difference between that and pending. You probably can't believe that. Temporarily off the market means that maybe something happened. They were getting complaints that the carpet was crappy. It was a puke green. People were commenting on it, so they took it off the market so they could get the carpet replaced, or maybe a pipe burst. Not canceled, temporarily off the market. They're still under an active listing agreement with the agent, brokers, still under an active listing agreement with their client. It's coming back probably on the market. And then pendings dropped. This is current today. So this isn't the last period. As of today, the current pendings on the market as of 2/28 were 336. As of today, 290. Sales are dropping. Already historic low sales. Concerning. Buyers are backing out. Let's go to the next slide. This is probably the easiest thing to do. We good? Does that say Montgomery County? All right, there we go. Montgomery County. Now, I'm not going to repeat everything. Everything goes the same as what I just said. Coming soon, we're seeing a pretty decent jump in 2 weeks, 214 actives. A pretty decent jump, 837. The price reductions dropped ever so slightly, but still 28.3% of the houses that are active on the market have had at least one price reduction. Active under contracts have gone up by one. Temporarily off the market, probably the same amount because it's the same houses. It's 2 weeks later, they're still not back on the market. Maybe they're waiting for a lightning bolt to bring them a buyer. Pending has gone up ever so slightly. Again, we're talking Maryland here. These are the counties that are directly affected by a lot of federal workers. So what you're seeing is not a catastrophe. What we're looking at is more of a catastrophe than it's a spring market, and things don't look good. They don't look good on price reductions. They don't look good on the limited inventory that's out there. They don't look good on the sales declining. It's showing us a whole different economic story that buyers are really, really struggling, and they're saying price is too damn high. Here we are, Howard County. Coming soon has gone up. Actives have shot up, 190 versus 148. Price reductions have come down slightly. Maybe some of that was absorbed or closed out. Active under contracts, pretty flat. Temporarily off the market, pretty flat. And pending is a decline. This is one of the hottest markets in Maryland, Howard County. Howard County, Montgomery County claim to be some of the best school districts in the country. People moved to these counties, did not put their kids in private schools, though many still do because they probably have a lot of money. Not saying that they work for the government, but Prince George's County, coming soon, 165 actives, shot up 966 versus 918. Price reductions have come down ever so slightly, still almost 1 in 3 houses on the market have had at least one price reduction. Active under contracts, pretty flat. Temporarily off the markets declined. They could have gone to canceled, could have fired their agents. Pendings have declined. Again, we're in spring, guys. It's March. Charles County, coming soon's declined. Actives have gone up slightly increase the number of price reductions. Active under contracts increased a little. Temporarily off the market, basically flat. Pendings way down. 2 weeks, 179, 156 pending today. Again, we're talking about percentages relative to scale. You may look at it and say, it's a lot, it's a little. Sales are way down, guys. Way, way, way down. Agents are feeling it. Loan officers are feeling it. Title companies are feeling it. No relief in sight. No expectation of mortgage rates declining into any number whatsoever that will make any sense at all. Houses are still priced at 2 and 3 handles, meaning that, from 4 years, the low rates, 2.74%, more 30-year fixed rate mortgage, 3.25%, 3.18 fixed rate mortgage, 30 years. That's where these homes are priced at, not at 6.5%, 6.8%. A percentage point's not going to make a difference. People are struggling. Frederick County, coming soon's going up a lot. 90 versus 64. Actives going up a lot. Again, relative 2 weeks. Price reductions have come down a little bit. Still more than 1 in 4 houses on the market have had a price reduction. Think of that. Still a big number. Active under contracts come down. Frederick. Temporarily off the market has come down. Pending has come down. Carroll County. This is getting into the outskirts. What happened is when we saw the DC job creations, hundreds of thousands of job creations, and the remote workers, it allowed them, or a hybrid model, it allowed people to go a little bit further out and still make it into DC that once or twice a week or once or twice a month if they had to. They were still close enough, but they were reaching to areas that maybe had different political views or had, counties that had a little different type of lifestyle as far as, being more in the country. Some people like that. Carroll County is one of those areas where it's a little more countrified, if you will. Carroll County, still a lot of impact could be felt from the federal job loss. And over the last several years, they've been trying to turn Carroll County into more of like a tech hub. And so a lot of these companies in Maryland are supportive businesses to federal government roles. All right, but look at this, guys. Coming soon's gone up. Actives have flattened out. Price reductions have increased. We went from 24.8% 2 weeks ago to 31.2%. So 10 more houses have had at least one price reduction. This is saying it ain't happening. Active under contracts going up a couple. Temporarily off the markets declined. Pending declined. Meaning sales aren't happening. Now we're going to jump into Virginia. Coming soon here, this is Arlington, Virginia. We're going to show you one of the worst counties in my study that I am really watching, really concerned about is in Virginia. I think they got a real, you-know-what storm coming. My guesstimation for several reasons. Maryland, we don't have a lot of new construction. Virginia's got a hell of a lot of new construction. We do have new construction. It's just we're not seeing a huge glut of new construction like we are in other parts of the country. Arlington, Virginia, coming soon, gone up slightly. Actives gone up slightly. Price reductions have gone up slightly. 28.3% of all active listings have had price reductions. When you're looking at 230 homes, that's a big number, right? It's over 1 in 4 active contracts declined. Temporarily off the market, pretty flat. Pending sales, pretty flat as well. Alexandria, Virginia, similar story. Actives have increased. Pretty flat on price reductions. Actives temporarily off the markets, and pretty flat on pendings. This is Alexandria City. It's just a little pocket in the county of Alexandria. And then Fairfax City here, same kind of thing. Coming soons have increased, flat on actives, big jump. Only 2 or 11% were price reduced. We now have 6 out of 19 price reduction, 31.6. Fairfax City of active listings, at least one price reduction, pretty flat otherwise. Here we go. Fairfax County. I think this is going to be something that we need to watch. If you're an agent in Fairfax County, I want to hear from you. You can reach out to me. You can send me an email. Maybe we'll bring you in on the next live stream. It's kind of hard to cheerlead, man. Really is upsetting when, I've always said that there's a couple things that are happening. Just leave this slide up because I want it to sink in. But what's happening here is that for many reasons, people don't want to admit what's going on in the housing market. Number one, their jobs depend on it, a lot of them. So they don't want to say, it's almost like a self-fulfilling prophecy. If I tell you not to buy a house right now, and you listen to me, I sort of write my own demise. Maybe I can't pay my mortgage. Maybe I can't pay my insurance. But what if it's true? This is what we're faced with. We have to say, is it good for you to buy a house? If you're putting somebody in that you go, man, they just slid by on that one. If it wouldn't have been for seller help on closing costs and mom scraping together what she had to give you $5,000, are you a first payment default in order for me to get a commission check? So what we have to do is come to the realization that it's kind of hard to tell people that they're okay and they want to be excited about it. But sometimes we have to face reality and say, you should sit this one out. Fairfax County coming soon shot up quite a bit. Went from 256 to 322. The actives jumped 25% in 2 weeks. We didn't see that in any other surrounding area. Price reduced did come down a little bit. But a lot of that is skewed by new home construction because they're raising prices, at least on the MLS. Active under contract has gone up slightly. Temporarily off the market has dropped, and pending sales has gone up a little bit. Nowhere near in a relative term to the 25% inactive listings. I want to go over to new construction homes in Fairfax, Virginia for a minute. And I want to show you this site and the concentration of new homes that are happening. 808 homes are reported on this site in the Fairfax, Virginia area. Now, I just showed you actives, including existing homes, are 781. The important thing to look at here is that new builders don't put their inventory on the MLS, most of it. So when we're looking at all the stats across the country nationwide and we're saying that the inventory is low, that's not true. Depending on your market, new home construction could be telling a bigger story. And you're seeing right here, we can just look at these spotlights. You see a price drop and a hot deal under construction. We click on the communities tab. There's 122 new construction communities in the Fairfax, Virginia area. So I think we need to pay attention to this. If you're in Fairfax County and you're wanting to buy or you're wanting to sell, you better be paying attention to what is happening here. I'm going to talk about for a couple minutes as we do wind down what I think you should be doing if you're looking to buy or sell right now and what we're seeing in the marketplace. But first, something was brought to my attention that is very dear to my heart, and it's the homelessness population that continues to grow around the country. And the reason being is because of what we've been talking about. People can't afford homes. And we're seeing where mental health problems are being exacerbated. We're seeing that drug addiction problems are exacerbated here. I mean, it's really tragic. And I want to just look at this site, usafacts.org, because I just want to show you a chart here on the states with the highest homelessness population. Washington, D.C. is number 2, according to this site. Now, you wouldn't think this because it gets cold here. We've had some of the worst, coldest winters this year than we've seen in a while. But I just wanted to take a minute and look at this. The amount of people that are living in RVs, that are living in cars, that it's crazy. National Mortgage Professional published an article on March 3rd that says record number of pending home sales fall through. A growing number of U.S. home sales are being canceled with the highest rate terminations for this time of year on record, according to a recent analysis by Redfin. 14.3% of homes that went under contract in January failed to close. Several metro areas are experiencing particularly high rates of cancellations, notably Atlanta, Vegas, Houston, parts of Florida, where housing supply has been accumulating. Los Angeles, obviously, the wildfires. So we're going to talk about this for a minute, and I'm going to try and give you some advice. If you're a seller in this market, in this troubled time that we're in, one of the worst things that you want is to find out that your contract's not going through. So first, I'm going to say, should you buy a house right now? I want to talk about that. Because for the most part, if you don't have to, the answer, in my opinion, and this may not be popular with my agents or my lenders that are in our friends and referral program, and to other people that are working in the housing market, I probably would say if you can't afford or you're questionable whether you can afford, I would probably say don't buy. If it were me or I were advising you as my family or friend, I would say wait until the summer. Now, if you're an agent listening, you're not happy with hearing this. But I think that we have enough evidence at this point to really go by things are getting worse in the interim, not better. The uncertainty of jobs, we don't know what's happening. Now, if you have plenty of money and you find what you're looking for that buying opportunity, and it's out there, do it. If it's a lifestyle, but not putting yourself at risk, your family at risk, just to say that you own a home right now. I think that this is even more critical right now than what I was telling you about 6 months ago because of what we're seeing with the costs that are going through the roof and the uncertainty, the high interest rates. Now, a lender will say date the rate, you can refinance later. Not always. Not if your home value goes down. They don't tell you that. If the home value goes down, the only way that you can refinance is to bring more money to the table. You might be stuck with that 6.5. They also don't tell you that there are other fees that are involved that go with refinancing. So what do you do if you are buying right now? So I'm going to tell you a couple things. We're seeing right here, right now, effects of DOGE affecting buyers and sellers, just like any other layoff would in private sector. If your job is gone, and a lot of these folks need to go through career training, look at what's available, may have to take jobs that pay less. And you can sit there and say, well, cry me a river. Well, don't listen to this, but we're still dealing with real people, real lives. The effects are going to spill over. It's not whether I'm for it or against it, whether it's necessary or not necessary, but you have to be mindful that it's happening and what kind of effects this is going to cause on a broader market. I'm hopeful for the future. I would love to see manufacturing come back to the United States. I just podcasted with Peter Schiff. He said something about we're sending our kids to school to do this job when we should be having them work in the factories, and the comments blew up on it. Oh, yeah, we want our kids working in factories. That's exactly what we want, Peter Schiff. But wait a minute, that's not really what he was saying. What he was saying is the hopes that if we get these jobs to do these employers to come back from these countries where tariffs are being laid and invest in our own country and get the opportunity to get good paying jobs here, eliminate the need to import things. This is a process. We may just have to take one for the team in order to see a better future for our kids. Who knows? It's all unknown. But we can't it's happening, so we can't just ignore it. So some of the things that are happening right now is that if you're buying a home or you're selling a home, I'm going to say one thing about the need for a professional agent. And you say, well, I can do this without an agent, and that's fine. Maybe you can. But if you're going to have a real estate agent work on your behalf, you just decide to do that. Make sure it's a good agent, because you want to make sure that you're following things through in the contract, and that if you're a buyer, you want outs. You want the ability to cancel contracts. So you have to be mindful of that, despite what the other side may be saying and telling you, eliminate this contingency, eliminate this contingency. I just had a buyer that was out of state. Maybe they're listening. And we were looking at a house about a week or so ago. And I went through the house with them. They're moving. It was remote. And they loved it. It looked good. We put a contract offer in. From the moment that we presented that offer as the negotiations start, the listing agent did everything that they could do to get us to eliminate our contingencies. We eliminated the financing contingency because they could pay cash. They were going to sell a home afterwards. We didn't have a home sale contingency. We bumped the settlement date or gave them the option. When do you want to settle? We could do it sooner than later. We can give more time. They said, well, it would be really good if you dropped that inspection contingency. Now, the house looked really clean. It was a limited showing. It wasn't like you could be invasive and go through their house and do all kinds of things like that. But what happened was we had written an addendum that said, look, guys, the buyer said, we're not going to nickel and dime these sellers. We're willing to do a home inspection and not ask for anything unless it collectively goes over $5,000. House is in good shape. They just want to know what they were buying. Just wanted to understand it. That must have been the deciding factor because we didn't get it. The sellers were disappointed, but they said, you know what? It's okay. We'll see another one come through. Got an email notification going off, Joe? If you're buying a home right now, I'm recommending that you pay attention to how much money you're putting down. Now, if you're a seller, you can pretty much assume the opposite of this, because if we're advising a seller, we're going to try and protect the seller. If we're advising a buyer, we're going to protect the buyer. If you're buying a home and your agent is telling you to put down a huge deposit, I would advise against that. And I do advise against that with my clients. I usually say about 1% of the asking price. So if it's a $500,000 property, a deposit of $5,000 should be okay. Some agents will say, but we want to show them you're serious. Well, we are showing them we're serious. We're writing an offer. We have a contract. We're trying to comply with this, work with the sellers. Because here's what happens. If there becomes a fight or that contract gets canceled and that seller doesn't want you to have your money back, depending on the scenario, you might not get it back. And if you have to take them to court, it may take years before you get it back. And if that agent convinces you to put more money down than you need as a deposit because you want to be serious, it could prevent you from writing another contract on a house. Look at the contingencies very seriously. Make sure that the dates in the contract are practical. Because you as a buyer may trust an agent to dates of a contract, but you don't really know if it's practical or not. So question the dates in the contract. And there's all kinds of dates. When are you how many days before you put in a application? Formal application for the loan? How many days before you get a acceptance letter from the lender? How many days before you are entitled to an inspection? How many days before you have to get back to them if you have problems with the inspection? How many days to settlement? Can you really settle within that period of time? How many days notification if the house doesn't appraise? There's a lot of dates. If I'm a buyer or a seller, I'm going to tell you, put those dates in your phone, set alerts in advance, question the dates. Don't just sign a contract. Understand the contingencies. When can I get my money back if this doesn't go through? The other thing are HOA and condo docs. Now, if you follow me on my channel, you know I don't really like HOAs or condominium associations, but depending on where you go, it may be impossible for you not to move into one. You better look at most contracts should be written that when you look at those condo docs, those HOA docs, you get canceled for whatever reason you want. It doesn't matter. You don't have to give that seller, your agent, or their agent a reason what you don't like in those HOA or condo docs. You just don't like them. You better be looking at those documents. You better be looking at assessments. How many times have they been assessed in the last 5 years. How many assessments have they done? How much are the special assessments? Because people look and say, oh, well, it's only $126 a month HOA fee. But they run it badly, and they run out of money, and they're whacking all of the owners for $4,000 on an annual basis in assessments because they can't make their bills. Financing contingencies. If your financing going through, being approved, is a reason for that contract to go through or be canceled, know what those dates are. Know what the requirements are of the lender ahead of time. A lot of lenders are idiots, just like agents. I see the biggest mistakes, believe it or not, with credit unions and lenders that are doing FHA and VA types of loans. I see a lot of mistakes. Or just the need to stay up on them. Maybe they're busy. But if you're packing up and getting ready to move, and the seller's packing up and getting ready to move, and you're relying on your agent that's not paying attention to the dates, it's not doing their job, the agent on the other side, the lender to do their job, you could really find yourself in a position where you're harmed as a result of not following your contract to the other side. So if you're a seller, a lot of these things go kind of hand in hand with that. If you're a buyer, I want to mention, if you're doing a home inspection in Maryland, and this is sort of, you're going to have to figure this out with your agent and in your state. But here in Maryland, when we want an inspection, we have an inspection addendum, and there's a lot of different things that are marked down there. Do you want a structural inspection? Do you want a radon? Do you want a insect? Do you want a environmental? Do you want a mold? Do you want radon? All these different things. You could check them off and say, I want these within a certain period of time. And then there's two parts to that. It's a termination clause, right to termination, and a right to negotiation. If you want an inspection, maybe one of the things that you can convince the seller, and they're going to be convinced more and more as time goes on, because it could be harder for them to sell their houses, in my opinion, over a period of time. Real estate's not a fast-moving incline or decline. It happens over several years. But one of the things that I'm going to tell you is that you could negotiate on this inspection addendum, and what the sellers are saying is, look, they're reading this new inspection addendum for us, relatively new, and they're saying, well, you can terminate it, buyer, or you can negotiate it. You can pretty much do whatever you want, Mr. or Mrs. Buyer. One of the things you may say is, look, we'll give you this home inspection, or we ask for this home inspection, but we're not going to just walk away. We're not just going to look at it and terminate it. We're going to go with right to negotiate. And maybe you can put something in there like I described. We're not going to ask for nickel and dime stuff. Well, reverse polarity on an outlet. It's an older house, and we recommend a GFI being in the kitchen, but it's 1970s house. It's never been updated. Seller's like, well, I never got electrocuted. I'm not going to fix that. It's not that big of a deal to put one in. You have to decide as a buyer, am I going to nitpick this deal and not get it, or do I need to write an offer? I'm not giving you exactly what you want for the house, and I want an inspection, but I'm willing to not ask you for every little thing that you lived with that's broken or not up to code. So these are the things that I suggest, guys. So we got a couple minutes here. Joe, I don't know what happened to, I can't see, to pull up questions. There we go. Never mind. I got it. So maybe we could pull up a couple questions, see what, I think I got it, Joe. I think. All right, here we go. So maybe we could pull up some questions. I can answer some things. Riley, I don't know if you have things tagged, But maybe we can, for the next 10 minutes or so, go over some comments or questions. All right, here we go. Do you think houses, I think what is being said here is, will the clear to close now be affected due to market conditions? Well, yes. We are seeing a lot of what's going on, and what we're witnessing right now is because of DOGE cuts. A lot of buyers that are under contract to buy, they don't know whether they're going to have their job. So the lender's asking for certain things like, you're moving from another state, you're transferring departments, you're doing these things. You're not going to get the clear to close from the lender if the financing isn't secured. That's a big thing. Also, we're seeing where there's a lot of issues that are happening. And by the way, on, I don't know, this week, Thursday, I think, maybe we'll get it out. We have a real estate attorney that is that owns a title company. He's going to be podcasting. We're going to be going over things like title, property tax fraud, whether it's unconstitutional. But one of the biggest things with title companies that we're seeing is that people are forgetting they have other loans. We just had a situation where the seller said, the title company said, well, wait a minute, there's another lien on this house. This guy has a loan, a second mortgage that wasn't disclosed. Oh, I didn't know that was a second mortgage. I got a home equity line of credit. Does that attach to my mortgage? Does that attach to the house? Can I just pay that after I sell? No. So a lot of people, what we're seeing is they don't even realize they have HELOCs, and they don't even know that they're second mortgages. Essentially, they're a lien on the property, and they don't have enough cash in the deal. So now the deals are falling through once they get to the title company, because the title company is discovering that they have obligations that are preventing that title from being free and clear of debt. You can't transfer title that way. We're also seeing encroachment issues. Title companies getting funny about whether they want to write a title policy, and a lender not wanting to lend unless there's a attorney letter or attorney opinion letter or a title policy. The lender doesn't want to fund the loan because no one feels confident about the title being free and clear. So we're going to see as this thing uncovers itself and people aren't getting paid for construction work and they're filing lis pendences, meaning litigation pending, mechanics liens, things that are going to come as a result of people that are maybe trying to bail out of their homes or their mortgages. Yeah. The economic condition is going to affect the housing market condition and certainly clear to close. So lenders are going to find out stuff, to discover things that maybe that the seller really didn't know. I wonder what's going to happen to white collar jobs when New York City starts laying off people, and how will that affect Connecticut and New Jersey for those that overpaid way over. I think if we just look at Massachusetts, we just look at Boston alone and the tech layoffs. I think what we've identified is, if anything in technology, if we find out where NVIDIA and DeepSeek, and how yes, NVIDIA apparently uses DeepSeek and it benefits by DeepSeek, but you have a Chinese company that comes in and starts producing things, or any country, any company comes in and starts undercutting or producing things for less. I think that we could see major whacks in tech stock. Look at Meta, the layoffs, the amount of layoffs. AI, we've yet to see the effects of AI. If you don't think AI is going to come in and crush employment, you're maybe not thinking clearly. The difference between the computer taking over the typewriter. When you say introduction to data processing back in the 80s, COBOL, well, automation didn't affect us back in the 80s and the 90s. We all just created other jobs. That's not the same as AI. We're not talking about somebody typing in on a computer versus a typewriter. We're talking about machine learning, eliminating the need for you and me. How's that going to create more jobs? Instead of telling me that I'm wrong, show me where I'm wrong. Instead of commenting that I don't know what I'm saying, show me what you know. Tell me what jobs are going to be created by machine learning and artificial intelligence. DOGE is using artificial intelligence to read the emails, apparently. How many employees would that take? Back to the point, blue collar jobs, it's going to be hard to get some AI machine to come and fix your heating and air system or go on the roof and put your shingles on. I mean, there will be automation in those areas that will probably make things go faster. Maybe there'll be bigger sheets. Maybe there'll be ways of, reducing costs through automation and some artificial intelligence. But I think blue collar jobs we're going to find are going to be, I mean, my gosh, you take your car to the mechanic. I get screwed every time I go. I'm pretty well convinced that the auto industry is, the service side of things is really corrupt. When you buy a car for $50,000 and you take it in for service and it costs you a fifth of that, or $7,000 to service it, how the hell did you ever sell it to me for $50,000? My mortgage company said I had a shortfall in my escrow account twice in 1 year, raising the price of insurance to 30% last time, and this time 30%, and they won't tell me if it's tax or insurance. Well, two things here. One, your payment's going up. I don't care what you think or what you've been told your mortgage payment will be. It's going to go up. Your escrow is going to go up every year. You're going to have a shortfall just like we're reading. And your insurance is going to go up and your taxes are going to go up and then your escrow is going to go up because your lender or the servicer of that loan is paying those bills for you, because if they don't, your house may get destroyed and the bank or the lender loses money, or you may get foreclosed on for not paying your property taxes, which, by the way, I've got an amazing video coming out. Mitch Vexler, second time on our channel, first video, almost over 400,000 views. It is fire. Man, is he opening up a can of worms on property taxes being unconstitutional and the bond fraud that's happening by the school districts and the central appraisal districts, what he's claiming to be fraud. And the submission to the DOJ, this is coming out this Saturday, 10:30 a.m. Eastern time. This is fire, man. Woo! This is stuff you ain't heard him say before. Escrow is going up. Some people's escrow have gone up $8,000 a year on their mortgages, and they can't afford it. And they're going into foreclosure because they can't afford it. When you believe you're in an overpriced market, how many days in the market do you suggest waiting to give lower offers? Great question. If you are somebody that wants to underbid the house the day that it goes on the market, you will probably lose. Especially if it's a good agent that's pricing the house to begin with under market to get you to be excited. And that's happening. People are saying, yeah, but the house right down the street went over asking price. Well, duh. They priced it for $50,000 lower than what they should have, or $100,000 lower than what they should have, because they knew it would get a frenzy going. So it's no surprise that it went over asking price. But if the house is overpriced or isn't worth the money, same thing, usually by 7 days, 10 days with no offers, the seller's starting to panic. Because when the house hits the market, you get the biggest rush, the biggest exuberance, the biggest flood through, and then all of a sudden you're like to your agent, well, we ain't got nothing? No offers? Nope. But we had an open house. We had 30 people come through. We had back-to-back showings for 2 days, 3 days. No offers? Nope. And then the agent, telltale sign, reaches out to everybody else and says, well, can you tell us what your client's planning on doing? We've got a lot of activity. Are they going to write? And you're going, nope. Usually after 7 days, 10 days, we're starting to see the sellers panic. But certainly once we hit that 30 days on the market, the deals are to be had. My advice to people is relax. Give it time. Again, if it's a single house that's coming on the market where only 12 houses have sold in the last 10 years and you want to be in there, you got to have it. It's something that's hot and you're willing to pay anything for it. By all means, dive in, buy it, give them whatever they want, whatever it costs to get the house, if that's you. It's not the bulk of people. Karen, big contributor to our comments on the channel. I've been a realtor for over 25 years, and I totally agree with you about waiting to buy. Thank you. Thank you. Thank you. Thank you. Here's somebody you guys should reach out to. Look her up. We don't see that often. Put that comment back up again. Insurance and taxes are so vulnerable right now. You do not know what's going up, and jobs are being lost massively monthly. Yes. All right, last one. We're in a worldwide recession, no question. As a result of Todd's advice, I got ready for it by selling one home to pay off debts. Feels good. Congratulations. Guys, I love you. Thank you so much for watching our channel, helping to make it one of the best real estate communities, I think, on the internet. And with your help and sharing the content, sharing the videos we've got a lot of Gen Xers, a lot of baby boomers that share this channel with their loved ones, with their children, their grandchildren. We have a lot of millennials, Gen Zs that are watching. One of the best things I could tell you, younger generations, is we're also on TikTok. I got canceled. That's stupid. TikTok, you're so dumb. Here's what they did. TikTok's so dumb. We were advertising, just boosting, and that's the only platform that we advertise on. We don't advertise on Instagram. We don't advertise on, boost our content on YouTube. Never. It's all organic growth. I think maybe we've done one or two Instagram posts we boosted. It's because we were bad at it and inconsistent with it and hoping people that will follow us just because. But now they're following us because we're publishing regularly content. But TikTok actually banned me for 10 years. They call it a temporary ban. I'm banned until like February 28th of 2035. I'm like, what? Somebody had to tell me that. I'm like, oh yeah, I got a temporary ban, but it's expired. And they said, no, you ding dong. It's 10 years from now. It says 2035. I'm like, what? Let me look at it again. So then I hit the appeal, and it comes back and says, your account's been terminated, canceled, indefinitely, gone, because you're a political, campaign. And we're not. We're like, you're stupid. We're real estate. We're not a political campaign. No. But they didn't cancel our TikTok. It's still up. We still get views. We still get comments. We still get extra followers. But what they did, this is why they're stupid. They prevented us from spending money. They said, well, you can't boost your ads anymore. We're not going to take your money to boost your ads, which is stupid. They should be grateful. Donald Trump saved their business. The United States saved their business. They were shut down. They were off the apps, off the whatever apps. I don't know, man. I think you need to look, if you're listening, TikTok, you need to check us out and open us back up so I could give you a couple dollars. Or just wipe us out. Just shut it down. Take it off the platform. But for you youth, we're there for you on TikTok or Instagram. For you Gen Xers and you baby boomers and the silent generation, we're on Facebook. I know that's where you love to be. That's your new news channel, your news station. But guys, I'm so grateful. Please keep sharing our content. Comment, like, subscribe. Help us make this amazing community. We can follow and track this together. I'll see you next time.